Welcome, entrepreneurs! In this session, we'll be diving into the advanced concepts of depreciation and amortization, two critical strategies that can significantly impact your tax deductions and overall financial strategy. Understanding how these processes work will allow you to optimize your tax position, reduce your taxable income, and improve your business's cash flow. By the end of this module, you'll have a strong understanding of both depreciation and amortization, and how to apply them effectively to your business. So let's get started. Let's begin with depreciation. Depreciation is the process of spreading out the cost of a tangible asset, such as equipment, machinery, or office furniture, over its useful life. This means that instead of deducting the entire cost of an asset in the year of purchase, you can deduct part of the cost each year, reducing your taxable income gradually. There are several methods of depreciation, but let's focus on three key ones. Straight-line depreciation. This is the simplest and most commonly used method. With straight-line depreciation, the cost of the asset is spread evenly over its useful life. For example, if you purchase a machine for $10,000 and it has a useful life of 5 years, you would deduct $2,000 per year for 5 years. Declining balance depreciation? This method allows for a larger deduction in the early years of the asset's life. The logic here is that many assets lose value more quickly in the beginning, so you're able to take a bigger deduction up front, which can be beneficial for cash flow. For example, you might deduct 40% of the asset's value in the first year, then 30%, and so on. Section 179, Deduction. This is a powerful tool for small business owners. Section 179 allows you to deduct the full purchase price of qualifying equipment and software in the year of purchase, up to a certain limit. This immediate deduction can provide significant tax relief, especially for businesses investing in high-value assets. Let's look at an example of how depreciation works in real life. However, Sarah wants to maximize her cash flow, so she chooses the declining balance method. This allows her to take a larger deduction in the first few years. In the first year, she deducts $6,000, which reduces her taxable income right when she needs the savings most. Alternatively, if Sarah uses Section 179, she could deduct the full $15,000 in the year of purchase, significantly lowering her tax bill for the current year. Now, let's shift our focus to amortization. While depreciation applies to tangible assets, amortization applies to intangible assets, things like patents, trademarks, and goodwill. Like depreciation, amortization allows you to deduct part of the asset's cost each year over its useful life. Here are the key points to understand about amortization. Amortization period. Most intangible assets are amortized over 15 years. But some assets may have different amortization periods depending on their characteristics. Deductibility. Just like with depreciation, amortization expenses can be deducted from your taxable income, helping to reduce your overall tax liability. Let's look at another example to see how amortization works. Meet Tom, who has developed a new piece of technology and holds a patent for it. He spent $30,000 to secure the patent and plans to amortize this cost over 15 years, as dictated by IRS rules. Each year, Tom deducts $2,000 from his taxable income for the cost of the patent, $30,000, 15 years, $2,000 per year. By amortizing the cost over the life of the patent, Tom reduces his tax burden and spreads out the financial impact of securing this valuable asset. When deciding between different methods of depreciation, or when amortizing intangible assets, choosing the right strategy depends on a few key factors. The type of asset. Is it tangible or intangible? How long is its useful life? Your business's cash flow needs. Do you want larger deductions now or smaller ones spread over time? Your long-term financial goals. Will immediate tax savings benefit your business more than deductions over several years? For larger, high-cost items, the Section 179 deduction is often a smart choice, especially for businesses that need upfront savings to reinvest in growth. No matter which method you choose, record keeping is critical. The IRS requires detailed documentation to support your depreciation and amortization claims. Here's what you need to maintain: purchase invoices and proof of the asset's cost, asset descriptions, including useful life estimates, depreciation schedules or amortization tables, calculations showing how you arrived at your deduction amounts. Keeping these records will not only protect you in case of an audit, but will also help you make more informed financial decisions. In conclusion, mastering depreciation and amortization is essential for entrepreneurs looking to reduce their taxable income and improve cash flow. The key takeaways from this session are: depreciation applies to tangible assets and can be spread over their useful life, with methods like straight line and declining balance offering different deduction strategies. Amortization applies to intangible assets like patents and trademarks, usually over a period of 15 years. The Section 179 deduction allows for full expensing of qualifying equipment and software, providing immediate tax relief. Maintaining accurate records is crucial for compliance with IRS regulations and maximizing your deductions. By understanding these strategies, you can significantly reduce your taxable income, enhance your cash flow, and set your business up for long-term financial success. Thank you for joining me today, and I hope you now feel more confident in applying depreciation and amortization to optimize your tax strategy.